Okay, we are diving straight in today with an analysis report on Ondas Holdings, that's ticker ONDS.
Yeah, this is that high-energy one, right? The crash or buying opportunity?
That's the one. It argues pretty aggressively that the recent pullback is a gift for investors.
And it all seems to hinge on one huge number.
Exactly. The report builds its whole case around this. Q3 revenue hit $10.1 million. That's a staggering 582% year-over-year growth.
A massive figure.
And the argument is that this proves their drone-in-a-box tech, the Optimus system, is finally hitting scale. So let's start right there.
Okay, so that 582% is, it's undeniably an explosive number. It's a brilliant anchor for a bullish piece.
It grabs you immediately.
It really does. But the analysis report needs to contextualize that remarkable growth against the company's, its profitability or operating structure.
So you're hitting on the sustainability question right out of the gate.
Have to. Because the report makes this really firm claim that ONDS is moving from a speculative play to a revenue-generating machine.
Yeah, I saw that.
And that's where the weakness is. The $10.1 million in revenue is the headline. It's the reason for this future re-rating. But the report, it almost completely omits any talk about the other side of the ledger.
Like cost of goods sold, operating expenses?
Exactly. Or critically, the net losses. Without knowing how efficiently that $10 million was generated, the 500% growth number, as amazing as it is, it kind of feels untethered from actual financial health.
Right.
It just makes it hard to fully buy into that revenue-generating machine claim. Because sometimes with these high-growth tech plays, the cost of getting that growth can, dangerously outpace the revenue itself.
That's a huge point. I mean, if they spent $12 million to generate $10 million in revenue.
Precisely. Then that incredible growth rate is only accelerating the cash burn.
So what's the suggestion here? How do you fix that?
It's actually pretty simple. To make the argument stronger, to really sell that transition from speculative to sustainable, the analysis has to integrate some analysis of the margin structure.
For the Optimus system and the defense contracts?
For both, yeah. Or, if that's not available, at least state a clear timeline for when they expect to achieve operational leverage. You can't just show the top line and say the transition is happening. You have to show how.
Okay, but let me push back a little. Isn't there a danger in focusing too much on profits right now, especially with these new defense contracts, the Iron Drone factor, which might be low margin at first just to get a foothold?
That's a fair point, and it's exactly why the report needs to address it, not just ignore it.
Ah, okay.
If margins are low because of a strategic investment, then say that. Frame it that way. Don't leave the reader wondering if it's just inefficiency.
So give us a concrete example.
Okay, for instance, analyze the gross margin trend that goes with that Q3 revenue. Is it improving? If the cost of getting that 582% growth is actually diminishing quarter over quarter, well, that's your proof right there. That's the efficiency kicking in.
And if that data is not public?
If it's not, then frame the whole analysis around the path to profitability. Ask the question, when does the firm expect to reach EBITDA breakeven? That gives a clear roadmap from a $10 million run rate to positive cash flow. That's what makes it a machine.
I like that. It proves the execution risk is manageable. Okay, let's move to the market reaction because the stock dropped.
Yeah, a pretty sharp drop.
Right. It fell over 7% to $8.48. The report's explanation is basically classic profit-taking and an overheated RSI after that massive 1,000% run-up. It calls the dip a simple cooling-off period.
And look, that technical take is accessible. I get it, but we need more. The explanation for a 7% drop requires a more sophisticated analysis than just generic profit-taking.
What's the specific weakness with that explanation?
Well, blaming a sharp sell-off like that only on technicals, it kind of diminishes the authority of the analysis, especially right after a record-breaking earnings report.
You're saying good news doesn't usually cause a 7% drop?
Not usually, no. When you see a stock fall hard on phenomenal news, it typically means the market, especially institutional money, found something they didn't like buried under those headlines.
A flaw in the guidance or something?
Exactly. And institutions aren't selling aggressively just because the RSI is a bit high. They're selling because of a fundamental concern.
Wait, though, isn't that a little high-minded? A lot of retail investors do sell when they see a huge run-up. Why not just accept the simple technical reason?
Because the whole point of this analysis report is to give a strong contrarian reason to buy the dip.
Okay.
If the report just says, it's noise, it misses a huge opportunity to prove the market is wrong. The best way to do that is to find the actual bearish concern that caused the dip and then dismantle it piece by piece.
So the suggestion is to be more proactive.
Yes, Proactively research and integrate a potential fundamental reason for the sell-off, even if it seems negative. Find that reason and then refute it. That elevates the piece from just commentary to, deep fundamental research.
And that gives the reader real confidence to buy against the trend.
Precisely. So, for some concrete ideas, I'd say investigate the commentary around the defense unit, the Iron Drone factor. It's labeled a massive catalyst. But did the guidance maybe disappoint investors?
A delay in contracts or something?
Or maybe higher than expected costs to scale up manufacturing. Another place to look is short-term guidance. Was the outlook for the very next quarter, say Q4 2025, a little soft? Investors can be very short-sighted. A flat next quarter can trigger a sell-off, even if the long-term story is great.
So you address the specific reason the market sold the news.
You find the pain point and you show why it's a misinterpretation.
That's so much more convincing. It shifts the argument from the market is wrong to the market sold for reason X, but reason X is flawed because of Y.
Now you're building a truly robust thesis.
Okay, let's move to the final piece, the big forward-looking target. Management dropped a preliminary revenue target of $110 million for 2026.
The cornerstone of the whole long-term bull case.
And the analysis report sees this as proof that the current $8 stock price will eventually look incredibly cheap.
And because it's such a critical number, the report should explicitly stress test that $110 million target. It needs to be anchored to specific milestones.
So the weakness is just taking it at face value?
Yes, the weakness is that it's presented almost like a mathematical certainty. But forecasting 2 years out for a company in this transition phase, moving from $10 million a quarter to a run rate that's 4 times that, the execution risk is enormous.
It's the single biggest point of failure for the thesis.
Absolutely. By not breaking it down, the analysis feels a little too optimistic. It's like setting a destination in your GPS, but not checking if you have enough gas in the tank to get there. You have to show the path.
That's a great metaphor. But look, that's hard work for an analyst. Breaking down management's own guidance into specific milestones is tough, especially if the company itself isn't providing that detail.
It is difficult, but it's essential. It's what separates a real analysis from just, echoing a press release. It's about anticipating the operational challenges.
So the suggestion is to build a roadmap for the reader.
Exactly. Break down that ambitious $110 million target into its component parts. For instance, what percentage comes from the Optimus systems versus the defense contracts? Then, identify specific, measurable things the company has to hit in the next 12 months to stay on that track.
Okay, give me a concrete example of a milestone.
You could estimate the required deployment volume. How many of those drone-in-a-box systems actually need to be sold or leased to make up, say, half of that $110 million? That's a tangible number people can track.
I see.
Or for the other side of the business, you could detail the expected timing of key Iron Drone defense contract wins that are needed to secure that part of the guidance. You're linking the future valuation directly to real-world achievements.
That makes the whole thing feel so much more grounded. It becomes a tool for tracking the company's progress, not just a prediction.
It lets the reader monitor the execution risk themselves.
Fantastic. The overall theme here is that the report has the vision right, but it needs to anchor that vision in the gritty reality of operational execution.
Well said.
So let's summarize. This analysis report has phenomenal energy, a really strong conviction, and it correctly zooms in on that 582% revenue surge. The foundation is there, but its resilience needs to be bolstered.
Right.